I'm Charlotte McLeod with the Investing News Network, and I'm here today with Adrian Day of Adrian Day Asset Management. Thanks so much for joining me this morning.
Well, thank you, Charlotte, for having me.
Of course, and we're here today at the Denver Gold Forum. It's the last day. How has the sentiment felt to you? What are the themes you've seen?
I think the sentiment is fairly subdued, to be honest. It's not overly negative. We've had a few years where, I thought we might have a few suicides during the conference, and we've had a few years with somewhat exuberance. This is more a little flat, I think, but I think the sentiment has picked up from last year, and for obvious reasons. I mean, when you look around, even though the gold price is down and the stocks obviously generally are way down, there's been a lot of M&A activity. Recently, there's been several companies with very, very good results, exploration results, and stocks are beginning to react to that kind of thing. So I think people are cautiously optimistic that the market is coming back.
What are your thoughts on the gold space right now? How should investors be playing the market?
Well, for now, I'm certainly cautiously optimistic, but I think if we look ahead, 3-4 years, I'm extremely bullish. And so the question always is, markets are forward-looking mechanisms. The question always is, when do you really jump in? Right now, I think there's some good signs that the market is turning, particularly the gold stocks. Gold stocks, as you probably know, is a broad generalization. In terms of price, we are for most stocks, we're back to where we were in 2001, at the beginning of the bull market. In terms of valuations, we're not at the absolute lows for the last 20 years, but we're very close to those lows for the last 20 years. When you think that gold has gone from $250 to $1,200, that's pretty staggering. But we're still at the same levels we were back then. Now, there's reasons for that we can talk about. So, first of all, the prices are low, the valuations are low, and yet, as I say, we're beginning to see a lot of M&A activity recently. One of my criticisms of the big companies, frankly, is that they are not, most of them, with some very notable exceptions, do not act countercyclically. This is a very, very, very cyclical business, as we all know, and it means that you, as a manager and a guardian of capital, you have to act contracyclically, meaning at the top you maybe put down your debt, take down your debt, eliminate debt, maybe dispose of marginal assets, etc. And at the bottom, maybe even take on debt, but use your cash to make acquisitions. And most companies have not done that. But we are beginning to see a lot of activity in the M&A. And I think that's a very, very positive sign because people are recognizing the value.
Right, and we should probably address this big M&A activity, which is Barrick and Randgold.
Right, well, disclosure, we don't own Barrick. I've avoided Barrick, not because their assets aren't any good, because I think the company is dysfunctional, but we do own Randgold, which has been a superb company run by, very, very dynamic CEO, Mark Bristow. The market has responded quite well. I'm a little bit, as a Randgold shareholder, I was sort of disappointed we didn't get a premium. I'm a little bit concerned at whether, or the extent to which Mark Bristow's management style, he's a South African, shall we say no more, his management style will translate to other parts of the world. He's been extremely successful in Africa. Will it translate? That's a question. But I think in the long run, if things work, it could be incredibly successful because, Barrick has some very, very good assets that we're not getting the most out of right now. And Bristow is very good at getting the most out of his assets.
Okay, and your favorite types of companies, those are royalty companies. What should investors know about those right now?
Yeah, let me back up a second if I can, why I like royalties. Gold stocks are extremely cyclical, as we know, and can be risky, whether they're the largest companies or the smallest exploration companies. And so I think for a lot of more conservative investors, you need to be exposed to gold and gold stocks, but you need to try to minimize the risk to the extent that you can. And among the senior companies, it strikes me that the royalty model is a much lower risk business model than the actual miners. You know, when you mine stuff, everything can go wrong. I think Robert Friedland, he may not have been the first one to say it, but Robert Friedland likes to say Murphy works overtime in the mining business. So things go wrong all the time in the mining business, and the mining companies, of course, are responsible for raising the capital, fixing the problems, dealing with higher taxes and NGOs and permits and everything else. The royalty company, which supplies capital to the companies in exchange for often 2-3% off the top, minimize that risk by not being responsible for the things that go wrong. So you look at a company, for example, like Franco-Nevada, which is the largest of royalty companies. It's about 15 billion market cap right now. Super strong balance sheet. Actually, they're only about 300 million in cash right now, which is one of the lowest it's ever been. That's because they've bought a lot of assets recently, but they have line of credit of over 1.2 billion, so they're fine, no problem, no debt. So good balance sheet, good people, very very diversified asset base. They've got about 38 royalties that are producing, and then they've got a pipeline of about 350 other royalties. So very, very diversified. And so when you invest in a big royalty company like Franco, you are getting exposure to, a dozen major mines around the world and a lot of smaller mines around the world. And you don't get that with buying one company like Goldcorp or, Barrick or anyone.
You spoke a little bit just now about some of the issues facing miners. What are some of the main concerns we see in the gold space right now?
Yeah, to me, the biggest problem, which is not a new problem, is misallocation of capital. And again, as I mentioned earlier, companies acting pro-cyclically instead of contra-cyclically. So in 2011, 12, 13, when gold went to 1800, 1900, you had all sorts of companies overpaying for very, very marginal assets. And we could go down the whole list. Those companies took on debt to overpay for marginal assets at the top. So 4 major things that they did wrong. And then, of course, in 2014, 15, 16, hardly any mining companies had cash to go out and buy the bargains or do joint ventures with juniors or anything, because they'd spent it all. So at the bottom, we saw companies paying down debt, selling off assets, precisely at the wrong time. And I think that's the biggest problem in the mining business, and that leads to the destruction of capital, because something like 75% of the 75% of the money of the capital that was deployed by gold mining companies in 2011, 12, and 13 has already been written off. So it's been written off before those mines have even come into production. Just a waste of it's money down the drain.
How does that happen? Is that just misjudging the cycle, or how does that happen?
I'll tell you how the companies, and I don't want to name names at this point, but I tell you how the companies explain it, because it's not a defense, how they explain it. They say universally that when gold was going to 1800, 1850, they were getting so much pressure from shareholders to buy assets. And shareholders, of course, in theory, own the company, and the managers did what the shareholders told them to do. Now, they didn't speak to me. And so you had a few notable exceptions, Franco-Nevada, Agnico Eagle, and there were others. There were others, but it was a minority. That Wheaton is another one, but did not spend money or very little money in those 3 years I mentioned, the 3 high years, and have been very, very active in the down years in making acquisitions.
That's all from me, unless there's any final takeaways you want to leave investors with.
Well, most of us who are listening on gold are already fully invested. But if you're not, I really, truly think this is a great time to be investing. There's some super companies out there that are very, very cheap right now, very cheap. Just have to be patient.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Adrian Day with Adrian Day Asset Management.
Thank you.